Hello, everybody. Thanks for joining us. Let's see. Ken. Ken had a nice trade today. There's Kirill. Ken had a nice pin today.
Yeah,
Mark,
he got it.
did you get it?
No, I was 10 points out. I thought my pin was at 890.
Oh, what made you choose that?
I don't know, the last 2 days, the pin was 10 points out of the main gex levels.
Oh, you're trying to second guess the Gex.
Yeah.
Hey, Jeff, good to see you. Good to see all you guys. Thanks for showing up. This is awesome. This is I think this is going to be my favorite presentation, my favorite guest.
Don't jinx me.
And we got to kick it off with my son, unless he's ditched me. Connor. Oh, I think he left. They weren't that good anyway. You can ask Ron. He heard them. They were sort of corny. They were there. I'll give you one of them. One of them was how do you make how do you what was it? How do you create a how do you make a small fortune trading options? And the punchline is you start with a large fortune, but not the way we trade them, right? So today I'm introducing you to my friend Ron Bertino, and I'm super excited about this presentation. This is one I've been waiting for. So this whole thing started off with around 2016. I ran across the trade, which was essentially the 112 trade. It wasn't called the 112 then. I saw it on some seminar. And if you don't know what the 112 is, it's well, I call it's basically a naked put position with a little tiny speed bump in front of it. And it's gotten really popular in like the last couple of years. And I made a bunch of videos on it why I didn't like it. But the thing is, when I first saw that strategy and I started to consider trading it, I ran across Ron somehow and I joined his program. And I've I think I've taken everybody's options course that is out there, everyone I could find. And when I found Ron's, it was head and shoulders above anything else I'd ever seen. It was kind of like it was like comparing the Motel 6 to the Four Seasons Hotel. It was like just the depth that he went into. He went so deep into like the second order Greeks and skew, and the way he teaches. He's an amazing teacher. He really explains things really well. And just going through his course, I immediately saw. I mean, I knew there was something weird about that 112 trade, but he just the way he taught and the strategy that he teaches really just showed, the danger in it and what the bad part of that trade. So I made these videos, and a lot of you have seen them and asked who. In the videos, I always refer to the guy who taught me the better alternative for the 112, which is who you'll meet today, Ron. And I've always also referred to this amazing group, this amazing options trading community that I refer to as the creme de la creme. And everyone's always asking about that. And so that's Ron's group as well that he runs. So what he's going to do, he's just put together a really amazing presentation today, really in depth on his trade and a lot of the ways how he looks at risks and his community and just the whole kit and caboodle. So I'm going to hand it over to Ron, and you can share whenever you want.
Everyone see my screen there?
Yeah, I can see it.
Perfect.
Can anyone else see it out there?
Yep, we see it.
All right.
All right. All right. Well, thanks for having me. So Dan has asked me to come on and basically show what our community does, how we trade, tools we use, all that kind of thing. And I told him it's a little tricky sometimes to do that because obviously I can't fully disclose everything we do in terms of all of the specifics. But I thought, all right, fine, I'll put together a presentation where I can get as close to that as possible without stepping over that line. And that's basically what we'll be doing today. So my objective is, as always, is I always do presentations. I try to present such that you can walk away with something tangible that you can start using straight away. And my hope is that you'll have a whole bunch of new ideas by the end of this particular session that you'll be able to start applying through to your own trading. Of course, like I said, I won't be fully disclosing everything. There's a lot of stuff that needs to be learned. And by the way, I should probably start there in that one of the reasons that I don't put out content on doing portfolio margin trading onto YouTube as an example, like plenty of other people do, is I just have this thing where my opinion is that there's a lot to learn about portfolio margin trading, because it's a bit of a, not just a bit of a two-edged sword, but it's quite a serious two-edged sword. And if you don't know what you're doing, you can get into serious trouble. So that's why I thought, you know what, I'm just going to stick through to teaching all of this portfolio margin stuff within the course material, so that way I can fully explain everything in detail and get everybody up through to a certain level, so that by the time they actually start trading this style, that they can do so safely, because it can be dangerous if you don't know what you're doing. All right, so as we go through today, feel free to ask questions as we go. I'm happy to answer anything. As a matter of fact, let me get my chat panel off to the side so I can see anything that comes in. All right, so let's get into it. So we'll start here, I guess, and that is that this is just a risk graph that more or less shows you the core trade that you'll learn about in the course. You'll hear this acronym called the STT, which is the space strip trade, but it's essentially like a hedged version of a trade. So think of this as kind of like the income portion, and then there's a hedging portion, and these two things are always combined. The vast majority of the trades that we explore within our community are structured in that way, so that hedging is a core component of the trade that typically gets put on at trade initiation. And we'll talk about the two main buckets in a little bit in terms of proactive versus reactive hedging, which we'll get in through to today, and you'll have a pretty decent understanding of all the different ways that we do both of these two main buckets to protect our trades. But if you think of this as a traditional kind of structure that you're more kind of familiar with, I know the curved lines may throw you off a little bit, but basically what's going on is that think of this as kind of like a broken wing fly. It looks something like that. And then over here, you could see that we've got the T0 lines kind of hooking up, and that is showing you that there's additional hedging that's applied around this area here, which lifts these lines up. And the objective there is that if you do get a move down of SPX, then typically that is going to imply that implied volatility goes up, and then that is going to grab this line, as a matter of fact, the entire line, but it will be most obvious from this particular level, and this will come up as well. So as the market crashes, these lines actually get less risky, not more risky, which is the opposite of what you'll see with a trade like the 112, right? The 112 gets significantly more risky when the market starts to crash and IV pops. And you can literally just get completely wiped out with a market crash if you don't know what you're doing. I'm sure you've heard, plenty of people that were trading 112 actually did get wiped out, which is always sad to see. So that is just a quick kind of look of what it looks like at trade initiation. Of course, there are going to be adjustments and so forth, and we'll talk about that as we go. But when you kick off the trade is going to require for you to you'll see that one of the main themes, and I'll talk about this in a slide coming up as well, in terms of mechanical versus discretionary trading. But everything that we do within our community is mechanical, typically. So what I mean by that is that everything is specific. There's no discretion involved. There's no, oh, I see this other person sees that. One person sees, a cup and handle. Another person sees a, double top. Another person sees, a candlestick, blah. Like, no, we basically want to define everything as specific as possible, so that if, when I teach something, I want trader 1, 2, 3, 4, and 5 to all be able to do the trade in exactly the same way and get the same results. All right. So as part of that, we kick off our trade setup with a sizing calculator here. And again, I've blurred out the specifics here, but I'll just give you an idea of how it works. The two primary things that go on are these two numbers over here. The lower expiration line here, if I go back to this here, think of this lowest level here as that level that we call the lower expiration line. that feeds in through to this number over here, because then that goes via the spreadsheet and does these calculations over here, which we'll get to in a sec. But that is one of the main numbers that are probably the most important one. And then also this number over here is essentially the P&L of the trade at a certain future point in time, based on what the modeling software tells us. And we have a specific way that we deal with that, because the reality is that what modeling software tells you will be the expected income at a particular future point in time, turns out to not be real. So the reality is that it needs to be discounted by a specific percentage in order for that to be more realistic. Okay. So, but we start with that number, and then the spreadsheet goes through and does those discounting style operations to bring that down through to more real world, realistic levels. From there, we now can calculate what our gross profit target is going to be. And then all of the other details are already filled in with what we recommend as the standard for this particular trade. But anything that's in yellow over here, these are things that you could potentially tweak if you wanted to. And I explain the guidelines of saying, stick between this level and this level. Typically, don't go beyond that. So as an example, for example, when we look at things like the max loss percent here, or actually, as a matter of fact, this one's a better one, the max loss multiplier here, you'll see that I typically say that your profit target, and by the way, a realistic profit target that you can prove that you can hit, not some, there are some traders out there that come up with a profit target of, $5,000, but the reality is they only reach, like $1,000 90% of the time. So what's the point of having a profit target that's that high? It's just not realistic. Okay. So we come up with a realistic profit target. And then from there, I typically set the stop loss level for the entire trade to be no more than 2 to 3 times whatever our realistic profit target is. Okay. For those of you that have done other trades, such as the 112 or even like a standard iron condor, the amount of money that you make can be, X, but then when you get like a big market move against you and you take a loss, sometimes your loss might be, 10 or 15X. That's not a good ratio. Okay. So, that's why we tend to stick. And as a matter of fact, the number that I have in here by default is 2. So it's the more conservative of that particular range. But somewhere between 2 and 3 is okay. I recommend not going beyond 3. And again, that is compared through to a realistic profit target that you can hit. Because otherwise, if you cheat and you say, as an example, if let's pretend like a number like 5K, and then you say, well, you just told me, you can use a 3 times multiplier for a stop loss. Therefore, I can take a $15,000 max loss. And that's what my trade plan will say. But the reality is that if you're actually only hitting $1,000 profit target the vast majority of the time, this is now 15X, not 3X, if you see what I mean. Okay. So that's why it's an important thing to know your trade via backtesting, which we'll get into, in terms of knowing what a realistic profit target for your trade is, so that these numbers actually make sense and they're not just, meaningless numbers that mean nothing. All right. So by entering, again, these 2 main things, everything else automatically typically just fills in, and you can get all the numbers that you need. So you'll want to know what your gross profit target is, because this now becomes the thing that you track on a daily basis to say, if I hit that, I exit the trade. You're going to also know what your max loss is going to be, which is this number down here in red. And that is also a specific number. If you hit that, without question, you just get out, right? It's not like, oh, I think this, or I think the market's going to bounce and, blah, 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 or I see this particular pattern, like not negotiable. Okay. If you hit your max loss, you get out no matter what. And then coming back to what this stuff over here is, this stuff over here is the stuff that will be used on a daily basis to potentially adjust your trade. So you can see here, we've got everything from very bearish to mildly bearish, neutral, mildly bullish, very bullish. You might then say, okay, fine. How do I determine what the current market bias is? Well, we have a completely mechanical way to determine these 5 levels of bias, which I'll show you in a sec. Okay. So if our so-called traffic light report says today's market condition is mildly bearish, then what these 2 numbers here do is that it gives you a range at which you should repoint or recalibrate your trade to have a certain position delta for your trade. So typically, if it's going to be, if the market is mildly bearish, we're going to be leaning slightly negative delta. And this is going to tell you a range. So this is going to be, from, minus X to minus Y kind of thing. And you'll know exactly what your position delta should be now reconfigured to in order for your trade to now be so-called balanced, right? And then if the day after that, there's a huge bullish move up and whatever, and the market condition now flips over through to very bullish, now these two numbers over here they're going to give you the range for which you should now be leaning slightly positive delta, right? But what I do want to make clear is that this is not for us to consider our trade to be a directional trade. The trade is actually a neutral trade, but what this is actually a form of hedging. And let's start to try and make things interactive over here. So if the market is going down and I want to, it's a traditional income trade. Our traditional income trade is going to be negative vega. Okay, so what that implies is that if the volatility spikes, a negative vega is going to cause a loss of money. So by us leaning slightly negative delta, then we're actually going to make money on delta, even though we're going to lose money on vega. Okay, so it's basically a hedge against the vega losses that we're going to take. Now, on the flip side of things, if we now have market conditions that are bullish, and we now want to now lean bullish deltas slightly, again, we're not turning it into a directional trade. We're just using this as a form of hedge. Can anyone guess what we might be hedging against? Because volatility, normally when the market goes up, volatility is going to come down. So we may actually be making some money from volatility. So why would we want to potentially be hedging in some way when the market goes up? Anyone want to take a guess? I guess it's actually a bit of a tricky one. And what goes on here is that there's another variable, something called skew. And what tends to happen is that more frequently than not, when the market goes up, skew is actually something that works against us in a similar way to when the market goes down, volatility works against us. Typically, when the market goes up, skew works against us. So by leaning slightly bullish deltas, that hedges us from the skew going against us, right? So again, I just want to make clear, even though we have this stuff here, do not think that what we're doing is doing directional trading. This is a delta neutral trade, but we're using this as one of the various forms of hedging that we use in our trading. All right, now something else that might be a little different through to the way that perhaps most people do trades is that most people tend to initiate a trade and then be in that particular trade until they close that particular trade. And then at that point, they take their win or loss, and then they initiate a new one. Nothing wrong with that. But what I'll say is that we do this type of thing, which what this is that if we know that we want to trade at size X, and let's just be consistent with this particular diagram, let's pretend that we know that we can do, let's just call them 6 lots. All right, 6 lots total in terms of the total number of contracts that you might be trading. Instead of going in and us putting on 6 slots for one particular trade and then waiting for that entire trade to finish and then reinitiating another 6 lot trade, we essentially do 1 lot week 1, 1 lot week 2, 1 lot week 3, week 4, week 5, week 6. And by the time that we get to week 6, we're now fully deployed from a tranche. We call each one of these things a tranche. Okay. So again, in the spirit of trying to keep things interactive, does anyone want to take a guess as to why this tends to be a more effective strategy than just doing essentially like one trade or one tranche or all of the tranches, if you like, all in one hit? Why do you think it might be beneficial to do this? This is something we call campaign trading, all right? But we're essentially, a hint is that we're kind of diversifying across a couple of different things. What do you think that might be? Dan says diversify. Yep, diversify against what? Ken says changing markets. All right, specifically what type of change are you referring to, Ken? You're right, though. Rich says time. Dan says movements. Ken says news. That's interesting. Ken says CPI. We've got strikes at correction, skew. All right. Yep. So a whole bunch of stuff being put out there, and they're pretty much in line with reality. So the option trading, unlike traditional, stock or ETF trading, which is most people call that, like delta one trading, you're making money purely from delta. So if you buy more shares and it goes in your direction, you make more money. But similarly, if it goes against you, you lose more money. And that's it. That's all you got to worry about, just price. Option trading is kind of like the onion concept, that it's multiple different layers. And actually, the more you learn, the more you realize there are even more layers than you expect. Once you start learning about second order Greeks and skew and all this kind of stuff. So, but the reality is, you're all quite right in terms of the various things that were talked about here. So you want to diversify with volatility, because nobody knows the future. And people say, volatility is mean reverting. Fine. That doesn't imply that it's not going to go up instead of down tomorrow. If it's so-called high, what does high mean? Who knows? Volatility can get beyond 100 with the VIX. But it's rare, of course. And if we're at, let's say, 20, then does that mean that it's going to go back to 10? No, it could go either way. You just don't know. So by diversifying through time, through here, we're diversifying that particular factor of implied volatility. And we're just essentially like dollar cost averaging, as you hear about with people doing that, in terms of price, we are implied volatility cost averaging kind of thing. And spreading our risk, because again, we don't know what volatility is going to do. Similarly, there are other variables that are going to be affected in that way. So for example, skew is another great example. Skew is going to go up and down and absolutely will impact your profit and loss. And you just don't know what tomorrow is going to be. So you might want to diversify skew out as well, which you can do with this type of thing. Another thing, though, that is quite relevant is just thinking of price action itself. So if SPX is here, let's just kind of go up and down instead of left and right like we normally do on a risk graph. But if SPX is at this particular level, and you know what, let me do the traditional view, which is like left to right. So this is currently where at the money is. And if you were to put on a trade, let's say here, and do your 6-lot trade, okay, all in one hit, this is your distance. And the reality is that, a traditional broken wing fly, you might make money in terms of the theta range, from, say here to here, something like that. This is where the juicy theta lives in terms of making money from so-called time. But what happens if the market moves in this particular direction and goes up? Now, if the market's here, your trade is a very far distance away from where the market is. And the likelihood of you making money in this zone over here is very, very low. Okay. So by not doing this and us simply doing 1 lot over here, and now if the market does move higher up through to this particular level, now when we put in our second tranche is now going to be here. So we've got 1 lot here, we've got 1 lot here. Now the market keeps going higher, the market's here, our third tranche is going to be here. Market pulls back, our fourth tranche might be around here. Pulls back again, it might be somewhere else. So what you're now getting is you're getting a much, much wider span of where your trades are going to be able to potentially make money from in a realistic way, as opposed to putting all your eggs in one basket and hold and pray that the market doesn't get too far away from you. Okay, so this is a way of kind of like stretching out our profit zone significantly by spreading out and doing campaign trading. All right, so there's quite a lot of benefit there of not just diversifying, but also expanding that profit zone that is what you really want. So this is the concept of what we call campaign trading. As part of that, though, then you might think, well, does that imply that I now have to manage 6 different trades? And the reality is no. We show you how to, even though we're doing all of these trade entries like this, we can manage things at a portfolio level now. And you get the tools within the course that shows you how to do exactly that. Okay. So the management isn't that difficult. You're still just managing one blob, one thing, lumps everywhere kind of thing. Once you've got many tranches on, that's fine. But you just manage that one thing still. Ken says, are most of your trades now 6-week duration? No. We tend to trade further out in time. But for not just because, that's our religion, but simply because there's an edge there. That takes a while to kind of explain, but if you want, I'll give you a couple of quick little ideas. So if you're doing a negative vega income trade, and I were to say, and I'll ask this, specifically to answer Ken's question here, but everybody feel free to answer there. So would you prefer to have your trade entry if IV is high or if IV is low in general? All right, you're putting on a negative vega trade. Yeah, high. Okay. So the reality is that when you go further out in time, the implied volatility goes up. So just based on that alone, that is one reason for you to say, therefore, there might be a bit more edge for me to trade further out in time if I'm going to put on a negative vega trade. Okay. That's one thing. The second thing is that this involves various, multiple things. Again, the layers of the onions come in, right? But when IV goes up, gamma flattens. Okay. And gamma is, so visually, if you have a trade that looks like, traditional, let's go to whiteboard. Let's say you do have like a broken wing fly like this, right? Gamma can be visualized as the curvature of your T0 line. So, and normally if the market's here, the gamma over here is going to be very, very flat, but then after that, it's going to start curving down. Okay. This curvature is the negative gamma. If you have the T0 line that curves up, this is positive gamma. That's how you can visualize it just by looking at a risk graph, right? Learning to read a risk graph is a hugely important skill, by the way. People that dismiss it are crazy. That you can get so much useful information from a risk graph. Okay, so my point though is that if you put on this particular trade at say 30 days out, then the gamma is going to be very big. So in other words, bad negative curvature like this. Whereas what happens is that if I go further out in time, then you get two things. One of them is that if you're placing a trade based on deltas, then the further out in time you go, you get what I call an accordion effect of the deltas. So in other words, if just to randomly pick a delta over here, let's pretend that this is 20 delta over here, and you're 30 days out. If we go out to 60 days, twice the distance in time, this 20 delta over here for the 60-day to expiry contract, let's pretend it is now over here. So now your actual structure ends up now being placed over here. If I now go another 30 days out to 90 days, my 20 delta might be over here now. And therefore you end up placing your structure over here. So you might say, well, pushing that away, doesn't that make the likelihood of me making money less because the structure is now further away from the money? Answer is no. But the accordion effect is one of the things. So therefore, this adds a layer of safety also now because the market has to come down much more distance before our structure or our trade gets into trouble because it's now further away from the money. So that's one benefit. I've already mentioned the other benefit of the fact that IV is higher, and we want IV to be higher with our negative vega trades. Gamma is lower. So in other words, the T0 line is a lot flatter. That's something we want because the market can go up and down. We just don't care if our gamma is flat. Okay, so gamma is lower. That's another benefit. And then another benefit is something called weighted vega. And I'd recommend that you go check out my a video. It's like a 1 hour video that I've got that teaches everybody on my YouTube channel, or public, what weighted vega is, and that is another impact. Okay, but basically the nutshell there of weighted vega is that if you're closer in time, it's kind of like, think of like a nuclear bomb kind of thing. If you are standing right next to that nuclear bomb, you're going to get totally fried. And then you've got radiation poisoning kind of thing that happens when you're further away. And then if you're 200 miles away, you just don't care. Right? It doesn't affect you at all. So that is more or less the concept of weighted vega, so that the vega impact tends to lessen when you're further out in time. And if you've got a trade that has a lot of negative vega, then you want that, right? You want the weighted negative vega, the weighted negative vega to be smaller. And that's what you get by going further out in time. So 4 or 5 different factors as to why trading further out in time is generally a positive thing, even though it may not be the most popular thing these days with everybody wanting to trade, 0 DTE and whatever. I'm not saying that's bad. I'm just saying there are certain edges that we can take advantage of from trading further out in time. Okay, so hopefully that answers all that. So campaign trading, we are very big fans of, and we tend to do that for most of the trades that we do. All right, mechanical versus discretionary. So here, yeah, I started trading late, well, mid to late 90s, and I've traded pretty much everything you can think of. And also that implies under many different gurus, many that were just absolutely terrible. But every now and again, I'd get lucky and I'd find a guru that was good in terms of the performance potential of what they could show. They could show actual trades and show profit. It's like, sweet, right? I finally found a guy that's not losing money. So you might think, okay, job done. Not quite. I would sometimes be in a scenario that I'd be studying under these people for years at a time. I'm not exaggerating, for years, methodically doing everything they taught, copious notes that I would take from their courses, uh, you know, really hard work kind of put in through to everything that is required, following them, for every single live trade that would do, everything you can think of. And then once I thought I had probably mastered the trade concept that they were teaching, because I could tell you exactly what to do when based on what they were teaching, I then said, all right, fine. Now I'm going to shield myself from looking at them and follow the thing they taught me to do. And the reality was it was terrible performance. Okay. And that happened many, many times. And what I came to realize is that it wasn't based on the trade plan. The trade plan was average. The reality, and there was a lot of discretion involved in that particular trade plan. The reality was that it was just that this person, this trader, had a good gut feel for the market. But they didn't know how to teach that discretion. Okay. They would look at a chart and say, I think the market's going up tomorrow. And the market will go up tomorrow. And then they'd say the market's going to stabilize, and the market stabilized. Now, the thing is that knowledge is trapped in their head, and they didn't know how to teach that to the students. So therefore, you now becomes reliance on that particular person. And the trade plan is not really that important anymore, because it's not about the trade plan. It's all about this knowledge that's stuck in that person's head. Okay. And I got super frustrated with that, because my intention was to learn to trade myself, not to be reliant on this particular person. And then that made me realize that it had nothing to do with the trade plan as well. It all had to do with just the gut feel that this person had. Just, so I don't know if you want to call it natural talent or learned skill, but it was a skill that the person either chose to not teach in order to keep you on the hook, or didn't know how to teach it just because they don't have that ability. Okay. And to me, that was, I've wasted literally tens of thousands of dollars. I didn't even want to think about how much money I wasted on courses, and the amount of time that I wasted on following all these people. So my transition throughout many years was kind of like from here to here, right? And the really nice thing about the mechanical trading is that once you learn to do it and learn to use the tools that are over here, and I'm talking about just tools for doing things like backtesting and robustness testing and so on, you can then very, very quickly, without having to waste time, be able to invalidate all of the crap that you come across out on the internet. You come across some guy that says, oh, this particular candlestick pattern, these moving averages and blah, blah, is the holy grail. And I've done fantastically with it for the past 5 years. You go, okay, if it's specific and I can code it up over here in a couple of rules and then run it through a backtester, I can now tell you exactly what the performance of that thing is. And what the reality is that 8 or 9 times out of 10, if not more, the performance will be absolutely terrible, right? Like this kind of thing. Now, this person over here, when they're trading it, might show you an equity curve that looks like this. And you might say, how do we, join these two things up? They can't both be true. The thing is, even if they're achieving this level of actual performance, what's happening is that they're using their own personal discretion, right? And I can tell you examples where I would be following a guru and they would be looking at a chart, with price action and whatever. And then over here, they would basically be saying, okay, I now see that setup number 3 that he teaches is good to go, and we're going to get into this particular trade. I would look at the exact same screen, and I kid you not, I could see 2 other setups in the same screen that had the exact criteria to actually get in. But I knew, because we were trading throughout this entire day, he did not take, the guru did not take that first instance and also did not take that second instance, but chose to take this one over here. And guess what? This one over here did not work. This one over here did not work. And this one over here that he took actually worked. This is what I'm talking about. This is him just having a gut feel that this trade is going to work out. And that's why the trade plan for him looks like this. And for you, when you run it through a backtest, actually looks like that. But if you were to then try it yourself without having his brain, you are going to get this equity curve. Okay. So this is why my personal feel is that, and what my recommendation is that if you don't want to waste time and money, try as much as you can to live over on this side of the chart, because you can, via backtesting, very quickly, without wasting years and huge amounts of money, be able to backtest something and tell if there's edge in the system or not. Okay. And once you've got that, you can then share that with a colleague or your son or daughter or whatever, and they'll be able to get the exact same performance from that trade plan without requiring the person's brain, just by following the actual rules. Okay. So since I transitioned like this is the way that I teach as well. So when you see our trade plans are fully mechanical. There's no discretion involved of I see this, I see that, I feel this, I feel that. No, everything's mechanical. All right. So here's an example. So this is that hedged STT trade, which is essentially like the core trade that you learn in the course. And you can see here, this is completely mechanical backtesting. Okay, this is not me manually doing anything. I'm just putting this into a backtester that we use, and we typically use mainly two backtesters that are quite advanced. And we get a graph that kind of looks like this. This thing over here is just a benchmark. In this case, it's just SPY, and you can see that we get really nice performance, right? When the market over here is in a grind down, our performance is still good. When the market over here is crashing, this was when Trump came into power and we had the tariff kind of issue. You can see that we do get a drawdown over here, but then we are tracking certain signals that says, you know what, market condition doesn't look favorable anymore. We're just out. And that's why we just get a flat line over here, even though the market just keeps crashing by another 2/3 from where we actually started. And in general, we just get a slow and steady upward sloping curve. And that's the equity curve that we want to see. In this particular case, you can see that this is a compound annual growth rate of close to 20%, which is what we typically, I'll be careful in how I say this. I was going to say what we aim for, but that can be misinterpreted, right? You don't start off with a particular performance target and work backwards. That's a mistake. And I made that mistake myself, right? What happens is you start off with building robust and trades that are as safe as humanly possible, that you're comfortable with trading, and then you see what they produce. And then that is the number of what you get for performance. Now, based on that structure of starting with trades that are strong and give you good performance with low drawdowns, when we then take a look at what the performance is that we're getting, that is a 20% number on the entire account. Okay, so that is what our community not just strives for, but can actually typically achieve with what we do. And you can just see that just in this purely mechanical backtest, pretty much hitting that. All right. Now, this technology here is limited in a way. It's good. It's as advanced as you can kind of see, but it can't take account into all of the mechanical rules that we actually have. We can put in most of them, but not all of them. So if we were to be able to put in most of them, the drawdown over here would be even smaller. Okay, but you can see that even just with this basic mechanical test here, we're looking at compound annual growth rate there of 19% with drawdowns that are, 60% smaller than what you see in the market, just with the basic hedge and this income trade, and that's it. Okay, and you can see it's pretty much quite consistent throughout multiple years, bottom left to top right kind of thing. 2024, you can see here, this was an odd year. You could see it basically tracked sideways during a period that the market was actually doing well. That was unusual, but overall, and again, this is one of the things that you learn when you learn to do backtesting properly, having a trade strategy that trades sideways or even draws down for a period of a year is actually not abnormal. That doesn't mean that strategy is crap. And you can see here that in 2025, the slope basically reverted through to the same slope of what we saw before. Okay. And tracking sideways is, perfectly fine. It wasn't a significant drawdown at all. You could see at the start of the year, end of the year there, it just went sideways for a year. Okay, fine. But now it's kind of back through to the normal slope, right? Even though the market over here took a pretty decent drawdown here, and yet the trade actually made money during that particular time. Okay. Yeah, you're right. Sorry, that was COVID over here. This was a 35% drawdown over here with the COVID thing. All right. So, Ken is saying looks like the August 5 debacle affected here. Yeah. So, I mean, you could see that there are definitely drawdowns that you see with this, but drawdowns that are 60% smaller than the market. And again, this is just using the initial proactive hedge. And you'll see by the end of this presentation, we've got many different hedges that we typically have on. All right, so that suppresses your drawdown even more. And I'll have specific examples so you'll see that too. All right, so when it comes to hedging, I've mentioned that in my mind, there's broadly two main buckets or categories. One of them is proactive hedging, and proactive hedging is hedging that gets put on at trade initiation. Okay, because you simply don't know when the black swan event is going to occur. By definition, it's a black swan. If we knew when it was going to come, it's not a black swan event. So that level of protection happens at trade initiation, and you can think of that as your protection or your safety net that gets put on at the start of the trade. Okay, it's just something you always do. Having said that, you don't want to dismiss tools that can potentially be useful to you after the fact that may tell you, hey, the market's not looking that great right now. And we've got various tools to do that. And again, fully mechanical, not discretionary in any way. Okay. The analogy there is kind of like, flying a plane. So if you were flying a plane in, the First or Second World War, you're just flying largely just by looking out the window. One of those kind of planes that had the two-level wings and all that kind of stuff. You just joystick and looking out the window and you're good to go. Maybe you got a speedometer or something like that, but not much more. These days, you can literally fly a plane from Los Angeles to New York with the entire windows blacked out from start to finish. Everything is electronic. Everything is using, all these digital readouts and what have you. And pilots are trained to be able to do that, to be able to fly a plane without being able to look out the window. So that is the analogy here. We want to be able to look at an instrument panel, and if the instrument panel tells us, "Hey, you're about to crash into the side of a mountain," maybe you should pull up, right? And that's what we do. So there's multiple reactive hedges that we take advantage of after the fact if we get a specific event type that comes up that tells us, "Hey, when we've seen this type of thing in the past, it can potentially mean ugliness is ahead. So let's adjust, right? And let's protect." So here's an example of the kind of thing that we were talking about before. This is just like a standard bracken wing fly type structure. This is a variant of the trade. It's actually something we call the 488. We have terrible naming, by the way. But anyway, this is a variant where the hedging component is actually in the same expiration as the trade, whereas the STT, by design, is the income portion and the hedging are in different expirations in order to primarily take advantage of weighted vega and also a couple of other factors over there that, in my opinion, there's an edge to doing that kind of concept. Whereas this one over here is just a variant of that for people that just want a simpler model where the hedging and the trade are in the same expiration. But the main point is that if this is what your tier 0 line looks like over here, and this is the worst circle droop level from your 0 line that you can see, when the market does come down significantly, you can see the market was here and it's now kind of coming down into the entry of that particular structure. You can see that by having that extra hedge over in this kind of area over here, that this is actually improving your T0, and your T0 is now coming up significantly, not down, which is what you'll see with kind of like the 112, right? So this is the proactive hedge concept that we talked about, and it's only one of multiple elements that we put into place in order to protect our trades. Right. Next one over here, which also falls under the proactive hedging bucket, is something we call LP factory. So the main concept here is, so you recall that we tend to like campaign trading. Remember, that's time diversification that we have for multiple different factors there, which we can take advantage of for the income trade. Now, that same concept can be applied to the hedge as well. And actually, multiple concepts that most people apply through to the income trade can also be applied through to hedging and should be applied to the hedging, even though people don't. So, but time diversification for the hedges are a good idea. To take advantage of multiple of the same kind of factors that I explained before about why we want to diversify through time. But what this is over here is that we are time diversifying for the hedge, and we're also partially financing that in order to bring down our overall costs. So we could start off, you could do, let's just say, one lot of your hedge on the first week, and then after 1 week passes, then you're going to do another version of that particular hedge. In this particular example, let's just say that we're focused at 30 days to expiration. So we're buying our hedges in this expiration at 30 days, okay? So over here, when we do one lot of our hedge, it's going to start at 30 days. Then over here, when we wait a week, now this trade over here is going to start at 30 days. This one over here is going to be at 23 days. Okay. Then after another week, we're going to do another lot of hedge starting at 30 days. And then we're going to do another lot over here starting at 30 days. By the time that's done, we have now built up 4 lots of diversification through campaign trading of the hedge itself. But what we can do, because obviously this is a debit when you're buying that particular hedge, so this would cost a certain amount of money. So what we can do is we can reduce our overall cost of all of the hedging by roughly about 40% by partially financing the overall cost over here by selling something against it. So what's going to happen in this particular case here is that when we do this tranche over here and we're buying our hedges at 30 days to expiration, we can then sell some options at, as an example, 7 days out to expiration. Then 7 days later, when we're adding our second tranche over here at 30 days, this guy over here has expired, out of the money, hopefully, and no longer exists. And now we're buying our second lot of hedges at 30 days. We still have a hedge over here at 23 days. And we then sell, as an example, at 7 days, something that can partially finance our overall cost. After another week, same thing. This guy disappears because it expires out of the money. Then we add our third tranche, sell something at 7 days. After another week, this guy expires. We sell something over here. Once this thing is fully formed, it's going to look like this. Okay? And from here onwards, what's going to happen? Now in week 5, when I now add my 5th lot of my hedge at 30 days to expiration, yes, I'm going to sell something over here at 7 days to expiration, but I now have this guy plus another 3 here for every one of these guys. So in other words, I'm now in a situation that I only have one, if we're just doing one lot as an example, one short put against 4 long puts over here. So overall, I've got positive vega. And this is why this chart is going to look like this and will remain looking like this moving forward in time. Okay, because on the 5th week, what happens is that this oldest one over here now expires. This think of this as the long hedge over here. Yes, that's expired because it's now gone 30 days. I still have 3 prior ones plus my new one over here for 30 days, and I've only got one short against that. But this process of selling a short at in this example, at say 7 days versus my 30, it can overall reduce my overall cost of hedging by 40%, which is actually quite significant. And what we found, perhaps surprisingly so, is that when we then get a market crash, that the performance of this kind of strategy, which is like a financing way of financing our hedges, reducing our overall cost by 40%, even though we reduced our cost by 40%, the performance is almost identical to if you just did this kind of portion like this and just bought your hedges without having to finance anything there in terms of what the P&L would be when the market crash occurs. And that may not be as surprising when you're thinking of the fact that this is what you have here. You've got these 4 tranches there of the long hedges, and you only really have one short option against it. It's not that much, right? These guys will, massively overpower the losses that you're going to take over here, as you can see from the risk graph. Even if the market comes down over here, these lines, let's say the market comes all the way through to here, you're not going to be there because the reality is that IV is going to spike, and these lines, due to IV spiking, you could see the vega down the bottom here. You can see you've got a lot of positive vega. That is going to push these lines up. So now you're going to be looking at something like that. And if the market does come down and IV spikes, you're actually going to be here. Now, so once you're fully formed like this, there's no risk there on the downside with an IV spike at all. None. Okay, so this is a really nice strategy to incorporate in through to not just your option income trading, but you could potentially do this to hedge anything. Your stock portfolio, your ETFs, whatever you want to trade, you could protect the downside like this. All right. And again, in the course or in the mastermind, you will learn specific mechanical ways to do this, zero discretion. Here's a backtest to show you that. So you could see that, yes, when you look at this equity curve, you might say, hey, that equity curve is not going in the direction that I want. But remember, this is a hedge. Hedges always have a cost component there, almost always. Okay, so it's completely natural to see the overall equity curve sloping down like that. That's fine. What you want to see is that you want to have market events such as this and see your hedges basically spike. Now, it's not going to happen always. Notice that when we see this move down here, yes, we saw a couple of spikes here, but nothing overall that significant. Whereas when we had this one over here, we got a really nice spike there. And this is another thing of what I was mentioning before of when you're looking at hedging, you want to diversify your hedges as well. Most people think, I just want to diversify my income trades. No, you want to diversify your hedges too. Okay, every market crash can be different. As you can see, of comparing that to this, right? And our hedges perform really well here and perform really well here. They only just perform kind of okay to maybe even not work during this particular crash. But a different type of hedge that I have may work fantastically well over here and not work that great over here. Okay. And that's why you want to have multiple layers of defense with your hedging and not just put all your eggs in one basket with just one type of hedge in your trading. Okay. So that's that. And then, of course, when you combine this with your income trade, because hopefully your income trade, is looking something like that, like we saw before. So yes, I mean, your income trade overall, your compound annual growth rate is going to diminish by a bit because there's like a drag cost of this particular hedge. But what's going to happen is that your max drawdowns are going to be hopefully are going to be squished down quite a bit. And that's what you want. You want to then find the balance between how much of this should you really put in when you're pairing that with a specific income trade, or when you're pairing that with your portfolio of ETFs or whatever that might be. Okay, so and that is why these types of tools are so useful, because you could do exactly that. You could grab your backtest that we saw from before, like the STT performance there, and then combine that with this backtest, and then build up an equity curve and just look at that and say, is that combination that I've created there something that I'm comfortable with? Can I sleep at night with a 10% drawdown? Yeah, I can. So I'm good. But in other instances, you'll find that's not the case. So you might need to add more or go the other way. Maybe reduce it. Maybe your drawdowns are at, let's say, I don't know, let's pretend actually they're at 10%, but you're more willing to take on larger drawdowns. Let's say that you're actually comfortable taking a 20% drawdown, but you want bigger returns. You can do that. You just reduce the hedging component in that particular instance. Okay, so pros and cons. You want to weigh that, but it's crucial to have the tools to be able to do this scientifically and mechanically without having to guess. Right? All right. Now, I mentioned from before that we want to be able to mechanically determine the market bias every single day. And this is one of the panels we look at. And as a matter of fact, for this market bias, you only need to look at this top row, nothing else. Okay. If this top row over here is white, white is neutral. If it is cyan, cyan is mildly bullish. Green is very bullish. Magenta is mildly bearish. And red is very bearish. That's it. This is your traffic light report, right? No discretion, nothing. You just look at the color. You instantly know what your market bias is. You then go back through to that spreadsheet, which told you, okay, if the market bias is currently, let's say, this one over here, which is mildly bullish as of the current day, the spreadsheet now tells you your position deltas should be rebalanced from this range to that range. That's it. If you're in that range, you don't need to make an adjustment. If you're outside of that range, you need to make an adjustment to bring it back into this range. Okay, so completely mechanical. All right. And what those adjustments are nothing more than vertical adjustments here. So this over here is just a put debit spread. And if you need to go the other way around, you can basically do a put credit spread if you need to get some positive deltas. Okay. Now, of course, you'll need to know exactly where do you buy this, at what delta or how wide and all that kind of stuff. That's all the stuff that we go into in the course, but that's all you need to do. You're adding verticals to bring you back in line to have a balanced, remember, portfolio, because you may have multiple tranches on at the same time. So, and you don't have to add verticals to every single tranche. You can manage things at an entire portfolio level if you want to. All right. Again, let me know if there are any questions as we go. Okay, and so that was proactive hedging. So we've got the hedges that are built into the trade from the get-go. We then also have the LP factory that I walked you through there. Those are the two core, and then of course the vertical adjustments kind of thing that fits into stuff that we start to do after trade initiation. So that now fits into reactive hedging. Okay, that's based on market bias. We add verticals. This thing over here is now another hedge that we put on that is reactive, so that we do after the fact. And what happens here? So this is a fairly significant pullback that we saw in the market. You can see that there's multiple rows of things that we track. Okay, and these things are, as best as you can get them, they're looking at different types of factors. So some of these things look at momentum, some of them look at momentum combined with volume, some look at different styles of tracking, different things and whatever, but basically it's all been coded up into the simple traffic light style report with dots. Okay, and I've explained how the first row works. All of the other rows down here are simply market condition indicators. We call that. And what that is that if you see a magenta dot, that is kind of like the first level of warning saying, hey, things are not looking particularly great. Things could get kind of nasty. And if they're red, that means we've got even more confirmation that that specific factor is not looking good. Okay. We then aggregate these 5 rows together into this market condition or warning indicator over there to make it a little bit easier to tally everything up. And if we have 3 market conditions being either red or magenta, then you're going to see this thing over here being yellow. Yellow doesn't trigger a response from us. It just gets us paying attention, saying, okay, I'm going to look more closely now, right? Once we get the magenta line over here, that magenta line basically means 4 flags or market conditions are fired. And when we see the red line over here, that implies 5 market conditions are triggered, as you can see, either red or magenta for 5 of the things that we track. And you can see, broadly speaking, that it tends to be pretty useful information, right? So you can see from, here up, we don't get any kind of those warnings. We had no warnings through here either. And then once things got through to this level, as you can see there, this is the first time that we got our 4 market condition indicators firing. That was where we would have added extra protection. And in this particular case, that served us well. And as a matter of fact, then when we get to 5, we add yet another layer of protection as well. And again, that worked out quite nicely. Okay. So, yeah. And again, completely mechanical here. There's no discretion involved. You simply look at this and you instantly know what you got to do. Ken is saying, are these trading view screens looked at once a day? Yes. We adjust our trades a maximum of once per day, no more. And that implies that we look at the market conditions once per day. There's no need to have your eyes glued to the screen throughout the entire day. As a matter of fact, you could even check once per day, even while the market's closed. Okay, if you can't look during the day, no problem. Just check it once a day. And then in the case that you did check it when the market was closed and you do need to make an adjustment, you then put in your adjustments the following day. Perfectly fine. Right? Our trades are very robust to be able to handle that kind of thing. And again, it's no more than once a day check and once a day adjustment. That's it. And you can frequently go multiple days without needing to do anything. No need to make any adjustments at all. Okay, so relatively quite hands-off style trading over here. All right, so here is a back test. Again, completely mechanical here, showing you what happens with this. Sorry, I should go back. So what this LPTA is, so you'll recall that we talked about LP factory, which was that concept of buying hedges every week up until we fill 4 weeks. And then we're essentially recycling. Okay. So that's LP factory. Apart from that, this is a different hedge that we put into place. And this is basically saying that we're adding extra long protection based on technical analysis. So in other words, by looking at these charts. And what happens is that we add our first layer of extra defense when we see a magenta line like this, which basically means 4 flags or 4 market conditions have fired. And then we add another layer of LPTA defense when we see a red flag over here. Okay. And again, to show you that there's no discretion involved, this is a completely mechanical backtest that's been done here. By the way, this is a backtester called MesoSim. Really good. And you can sign up to it yourself. You don't need to be a TD member or anything like that. So a bit of a learning curve to learn how to use it, but very good. And you can see this thing over here, when the market over here has the crash event, this thing responds really nice. And also when we have this significant pullback over here, this one performs even better, right? So, and what's interesting about this is that notice that the drag factors, in other words, before when we were looking at LP factory, we had an equity curve that basically looked like this. It went down, it spikes up hopefully during a crash event, but then kind of, keeps going down, spikes up during a crash event, and then keeps going down. More or less is that drag factor from, a slope down kind of effect for the actual equity curve. Whereas over here, for this particular trade, yes, there's a bit of a drag over here, and there's a bit of a drag over here, but largely it's more or less just tracking sideways. Okay, so the drag factor of this style is quite a bit less in terms of the cost, right? That kind of drag is less than what you see, if I go back, less than what you see here, right? That's pretty clear that there's a drag cost factor there with this particular hedge. But like I said, you want to diversify your hedges, so we do both. We do the LP factory, we pair that with our income combo trade, which also has proactive hedging built into the actual trade. And then as part of reactive hedging, as the market is coming down, we're adding vertical adjustments. And on top of that, once we get our 4 market condition or 5 market condition indicators firing, we add 1 or 2 extra layers of extra defense based on this LPTA concept. right? So that's what the backtest looks like there. If we take the trigger of as soon as we see 4 red flags or magenta flags, we add our layer of defense. And then this is what the backtest looks like if we ignore the 4 warnings and only take action on when we see 5. And you can see that this still responds and still responds with not much of a drag factor there. Okay, so our backtest validates that it's a useful thing to add to our overall trade. Now, this one over here is another one that the TA component looks at exactly the same thing, the same chart that we looked at before, the 4 or the 5 flag warnings, and it takes action based on the same thing. And it's just like an extra layer of defense. But what happens is that this defense is placed differently than simply buying extra protection out of the money. So in other words, think of what the LPTA concept does is that it buys extra hedging kind of like out here kind of thing, right? It's a fairly decent distance from the market. It still responds very well, but this is a way of us adding another type of hedge at a different location in terms of in the option chain so that we get that level of diversification as well. Okay. Anyway, so what this thing over here is, it's called a PBR because it's a put-back ratio. It's the blue line that looks kind of like that. And it's done for even money. So in other words, the way that you do that is that you're going to be selling options at the money. And you take note of what your price is over here. And you then look for where the price is half of this one over here. And you're buying, so you sell like one lot over here, and then you buy twice as many at half the price. So what that implies when you kind of put on that particular trade is that you're putting this on for even money. Okay, so that this upper expiration line is basically at the 0 line. So if the market zooms up purely just based on price action and the T0 line, you shouldn't necessarily lose money. Of course, though, you can lose money due to vega. Okay, but that's another issue. So, but the point is that we're now adding extra longs over here, and we're financing those longs by selling some options over here. And this is just another way of us adding an extra layer of protection to give us this positive vega protection for our negative vega trade. And you can see here that since this is now kind of like a third layer, because we've got the built-in protection to our income trade, we've got the LP factory. These are the 2 proactive hedging strategies. Then we've got the LPTA, which is the first reactive one that we put in. This is essentially like yet another one, if you want to put it that way. And so what happens is that since we know that we've already got our trade protected kind of quite well, this is just that final band-aid, if you like, that you put on. And so what happens here is that we take a look at our total vega exposure of these 3 things combined together, and then we only hedge a certain portion of the vega when we hit the 4 flags, and we hedge another smaller portion when we hit the 5 flags. So the concept is still the same. When we hit 4 or 5 flags, we add an extra layer of protection using this style of trade, which is different to, it's just a way of diversifying the type of hedging that you're putting into place. And this is how it reacts during a market crash, as an example. So you could see that when the market comes down, these lines pop up even higher than where, if I go back, you could see here, this is where, if you look at the vertex here of the trade, you can see that the T0 line kind of intersects at that same level. Whereas when the market crashes and IV spikes, you can see that the line over here popped up. All right. And then if the market now does come down and IV spikes, these lines all kind of pop up and you get some juicy profits there with a market crash event. All right. But you do need to learn how to size these things properly to your income trade. And that is what you learn in the course and the mastermind. And here's the mechanical backtest of that. You can see, again, with this crash, this is now the putback ratio based on TA, and we get similar pops there in terms of profits. There is a small element of drag, but you can see it's very small, right? Quite gradual. And for certain types of market crash events, we get nice pops there from a hedge, which is what we want to see. All right, and this one was with 4 red flags, and then this is with 5 red flags, similar to what we saw before. All right, so those are the key forms of extra hedging that we have in place. So one of the things you might be asking then is, how do I take profits on that? And that can be surprisingly tricky because during a crash event, it's really nice to see these extra hedges really blow up in profit. I shouldn't use the word blow up, but increase in profits, and your greed will kick in when that tends to occur. And you'll then say, oh, tomorrow I might make even more, right? So, but what happens is that when you're in a market crash event, yes, volatility can keep spiking for sure, but at some point, the market's going to bounce, and it's not unusual to see the bottom bounces and IV just get completely crushed when that happens. And you could be in a scenario where you're like up here, and you're laughing because you're saying, "Sweet, I'm getting huge profits from this particular hedge." You keep holding, and then when you get that huge spike in the market bounces and IV crushes, this thing over here now drops all the way down to here. All right, well, the market's coming up. You might be down here as an example. Okay. And you've now lost those potential profits that you could have cashed out on had you booked those profits when you're here. So basically, the nutshell is that you need to have a trade plan which tells you exactly how to get out of these hedges when they're making money. So the way that we track that is that we track a multiplier of the initial price that we bought this hedge at originally. So in other words, if I buy it at 1x, then there's a certain multiplier over here that we then say, okay, from this point forward, we are now going to start tracking a trailing stop of this position now that it's hit this activation level. And then if it comes down a certain percentage, and again, we're specific about this in the trade plan, right? But if it comes down a specific percentage from the peak profit, that is where we cash out of that extra hedge. Okay. But the key is you just need some form of a mechanical form of getting out for profit from these things, because from experience, I can tell you that greed kicks in when you see this, right? Sometimes it works, sometimes it doesn't. I had one guy during a crash event say my entire account just went up by 30% because of all these extra hedges that he had. I'm like, make sure you've got your plan and follow the plan, right, to get out, because those profits can evaporate very quickly when you see that market bounce and a big IV crash. Ken saying, if you have 4 to 5 days in a row and you're adding a new hedge every single day. No, not necessarily. That is the rules for that, Ken, are fully defined in the trade plan. As you can see here, this is a fully mechanical backtest, so the rules will be specific and defined within the trade plan for that, right? Again, I mentioned I can't fully disclose everything. I'm trying to give as much value as I can without crossing that particular line. Larry says, what is the approximate capital required to run such a campaign with a single lot per tranche entry? That again is also fully covered, Larry, you'll remember from before that I mentioned that you got a sizing spreadsheet, right? That sizing spreadsheet that we looked at the very start, that will tell you exactly what your planned capital needs to be in order to follow that particular trade plan. And it's a very important part of everything that we look at with portfolio margin trading, right? Planned capital is something that is very important to know well, and is something that you also need to have a good backtesting tool that can guide you as to what a reasonable planned capital is for that particular trade. Okay. So if you want a basic idea of that, so we've got certain trades that will have per tranche a planned capital of about, let's say, $15,000, just to give you an idea, right? That's one tranche. Obviously, you can scale that up. So we've got people in our community that literally run hedge funds that trade millions of dollars worth of planned capital all the time. So obviously, they're doing in some cases like hundreds of lots and so forth. But in terms of bringing it down to the smallest components, or one lot kind of thing, or one tranche, I guess is a better way of saying it. Think of it as about 15K or so. But that is trade specific, and we have explored many different trades in our community, right? All right, this is something I call an opportunistic trade, or an opportunistic hedge. And this is a call ratio diagonal. It basically looks like this, but it will only look, and this is at trade initiation, by the way, it will look like this, but it will only look like this at a time when the market is starting to come down. So it will look really ugly if the market is just grinding up. It looks horrible, the trade setup. But if you now do get into a situation where the market now starts to come down, and again, we have a specific thing that we track for that, then at that point, when you then check the trade construction, you can regularly get trades that look like this and look really nice. You can see here your T0 line. If the market comes down, you make money. As a matter of fact, if you can see, you also have positive vega, so that if the market comes down and IV spikes, these lines actually come up higher than where they're at.
Quick question. Can you,
Sure.
it looks very nice for the situation if the market goes down, but can you reverse it and make it to the opposite direction?
Yes. Well, if your question is what happens when the market goes up,
Yeah.
based on this risk graph, this
Yes.
risk graph is basically claiming that you should be okay. But since you've got this positive vega, if the market bounces higher and now IV crushes and comes down, then you having positive vega implies you're going to take a loss, and these lines push down if IV goes down.
Oh, I see.
Okay, so that's part of the reason that you'll learn that we want to slightly tweak the starting delta here, ideally to, I mean, in this case, it's actually, flat, but the ideal setup that we want to see is we want this particular one lot style tranche to ideally be at a delta of about 2 positive delta. So we want to slightly lean positive for that same reason that I just mentioned, because now our delta is going to hedge the vega crush that we're going to get if this thing actually goes higher. Okay, but just keeping this completely flat, this is actually I'll show you the backtest coming up for this in a second. This is what I was talking about. When the market does then continue down and you then get that IV spike, you can see that our T0 lines and all our T plus X lines, they all pop up. And when you're at this particular point, there's no point staying in this particular trade. When you get this kind of scenario, you just cash out and you take your money. Okay. And here's the backtest for that. So you could see this one has an even smaller, as a matter of fact, I would say this has almost no drag, right? You could see that when, this thing tracks more or less sideways when it's kind of like not working, put it that way.
Yeah.
Right. Which basically is the condition that you're saying, when it doesn't do what you want.
Condition.
Yeah, when it doesn't do what you want.
Could you tell me why
it's
backtest only till end of the 2022? So
yeah, this is just because I was borrowing the screenshots from when we did the mastermind sessions on these things. Yeah, but you can absolutely run the backtests to any kind of date you want. But that just gives you an example of how it goes on. And this is completely mechanical. The reality is that when you build a risk graph, that this is the one time where I will sometimes add that layer of discretion, not discretion for the trade plan. The trade plan is always going to be absolutely fixed. But if I construct it and it just doesn't look like this, doesn't look good in terms of the potential of making money, I simply won't initiate the trade. Right? So, but if I do initiate the trade, I follow the trade plan to the letter, like we always do. Everything is mechanical in what we do. Okay, but yeah, you can see here that the drag is almost non-existent there, which is really nice. So it's a really extra nice hedge that you can add, which has almost no drag, which is cool. All right, I've already kind of alluded to this in that the way that I teach anyway is that your profit target, which should be realistic, should have a stop loss no more than 2 to 3 times what your realistic profit target is. If you follow this rule alone, I think your trading will tend to go much, much better than what it may have done in the past. But remember, the profit target needs to be realistic. Okay? It can't just be some inflated number, because otherwise your 2 to 3 times multiplier is meaningless off an inflated number. So summary here, we've talked about proactive hedging. So we had the built-in hedging that is built into every single trade at initiation, because we just don't know when that Black Swan event is going to occur. We've got the LP factory, which was us entering into an extra hedge every single week, and we can partially finance that and reduce our cost by 40% and still have a really good extra layer of protection there. And you can use that not just for your income trades, but also for your stock portfolios and whatever else you're actually actively trading. And then on the other side, we've got the reactive hedging. We talked about vertical adjustments. So we check our dashboard once per day. That top row tells us exactly what the market bias is. And from that, by the way, when I say it tells you what the market bias is and the dot and blah, 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 don't think that it's a black box either. All right. You'll learn exactly what the rules are to define the colors of the dots. So we don't hide any of that. That's all open to you once you join. But then based on that, we now know if we need to make a vertical adjustment on our trades based on the current market condition and based on what the spreadsheet told us that our delta range needs to be for our portfolio. Okay, so we know exactly what those levels need to be. And then based on either seeing 4 or 5 red flags from our dashboard, we can then do the LPTA, which is adding additional protection based on this technical analysis here of the 4 of the 5 signals. This one over here is that extra last layer of doing the put-back ratio instead of the traditional extra hedging. And then you've got this opportunistic way of just making money from market coming down by doing this call ratio diagonal trade that I showed you guys. So on top of that, for these things in particular, for these extra hedges, you absolutely need to know how to define what your profit target level is going to be and what your trailing stop is going to be for that particular trade. And always, 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 always have a realistic max stop loss, which is no more than 2 to 3 times your realistic profit target, and always follow it. Always. Right? Not sticking to this rule is the biggest reason you'll see people blow up their accounts. And I've seen that, unfortunately, quite a few times with people. Fortunately, not too many times with people from my community, because I drill this into everyone's head to death. But I've had, I think, 2 or 3 people that have been members of my community and have had, significant drawdowns. And my first question is, did you follow your trade plan? And their answer was no. Right? I thought the market was going to bounce. I thought it was going to come back. And it's like, okay. All right. Always stick to your max loss. All right. So you may have heard me mention the mastermind, and you'll see that the course, the PMTT course, is probably the most thorough course you'll get on advanced option trading that's out there. But that said, the mastermind will be presented to you at the end of the PMTT course. It's optional. You don't have to do it, and you'll know how to do that core trade, right? The STT with the hedging and all that kind of stuff, and the dashboard and all that. You'll know how to do all that. But if you want to go beyond that and you want to work collaboratively with other people and explore, we've literally explored like over 100. Actually, I think we're probably close to 150 now, different trade types and what have you. And collaboratively work with others to tweak it, to evolve it, to split up the work and backtesting. You backtest this, I'll backtest that, and whatever else. That's what we do in the mastermind. And so it's only available to people who have completed the PMTT course. I do not make the mastermind available to anyone other than that. There's a 7-day free trial with full access to everything, so you can confirm that it's just as valuable as I claim. After that, it renews at $30 a month, which is nothing compared to what you see many gurus charging membership for. You'll see people charge $200 a month or whatever. So $30 a month, I think you'll see is very, very affordable, and you can cancel at any time yourself without even having to notify me. So this is the type of stuff that you'll get. So from there, you'll get access through to a mastermind private channel, and again, you can see that we're all kind of working collaboratively, sharing stuff. At the moment, we're all kind of working on converting a lot of the trades that we use certain tools for, which are paid tools online, and we now recode them into Python ourselves and then share the Python code among the community so that we can now run everything locally on our computers and not have to be reliant on this third-party service and not have to pay the fee for this third-party service either, right? And we're all working collaboratively on that. You can see there's currently about 428 members that are part of the mastermind, right? There's like over, I think, 1,400 or something that have done the PMTT course, right? But the mastermind, there's about, over 400 people there. Then Slack, for those of you that use Slack in some other communities, this is the free version of Slack, which means you get access to the prior 3 months of history. But I've done interesting things, which are all legal, but I've done some stuff over here, which has enabled me to keep a log of absolutely everything. So you can see here that you could go back even through to 2017 when the mastermind originally launched and get the full history of everything. Okay, so you'll have not just the last 3 months, you'll have everything there if you want to read through that. Then we've also got mastermind forums with hundreds of threads there and thousands of messages that you can see there. This is, again, a private thing that you get access to when you join the mastermind, and there's a ton of really, really good information in there. And then this is showing you the bi-weekly live meetings that we do. You can see I've done almost 250 of them, and each session tends to go for 2 to 3 hours, and fully document everything that is done in each one of these sessions. And there's like a search bar over here on the right in the database, and you can just type whatever you want, like a trade name or what have you, and it will give you a short list of the actual lessons that dealt with that particular topic, right? So you can just easily navigate, jump around, and explore. And again, with 250 sessions, each one typically at about 2.5 hours, there's a ton of really useful content in here. Everything from hundreds of trade types that we explored, guru breakdowns, trading tools, automation, AI, you name it, right? There's just a ton of really cool stuff in there. And what I'd say, by the way, is, the one piece of so-called constructive feedback I get from people is that it's almost like too much. They feel overwhelmed with just having so much information. So what I'd recommend is to kind of stick through to the latest sessions, because those sessions tend to be the things that we then talk about most in Slack and in the forums. And also just keep an eye out for the trade names of the things that people are actively talking about, because those will be the trade types, the current trades that our community are actively trading. Because you'll find that is an evolution in itself, right? Because you may have a trade that works well for sometimes years, and then suddenly it just kind of like stops working. And so when we find that, we maybe now develop a new trade type that works well in that particular market condition. Okay, and we'll kind of maybe pause trading on that prior one and now start trading these 2 or 3 new trades. So at any point in time, there's typically 3 or 4 popular trades that are good for the current market conditions, and just stick with that, right, to start off with. And then as you're a member, feel free to explore all of our archives, because again, there's just a wealth of information there, tons and tons of useful info. This is the other advanced backtesting tool that you'll have access to. And the cool thing, so I mentioned Mesosim, that's a paid tool. They've actually just increased their pricing, I think, through to like $100 a month for that particular tool. This tool is called Trade Tracker, and the developer of this tool is a member of our community, and he has been generous enough to make it completely free for mastermind members. Okay. And you can do really advanced stuff, and the GUI that's been built up with all of these different things may look weird to some of you or not, but basically these are all things that are specific through to how we tend to do trades. So it's not just a really good advanced backtester, but it's also built for our community, for our trades, if that makes sense. So, and you can build your own stuff with all the different criteria, which is very powerful, but you could also then get access through to saved simulations, which are, again, private through to our community only. and you've got tons of trades that we've explored and done backtest, and you can review all those trades. So that's really good. You can also you leverage their portfolio ability. This is kind of like what I alluded to before, where you can have, you're investigating some kind of income trade. It may or may not be the STT, it could be others as well. But then you say, all right, well, I now want to pair that with, hedging strategy number 3, whatever that is. And you can now combine these things together into a portfolio and now get to see the equity curve and drawdowns and all that kind of stuff for this combination of things. And then you can say, you know what, I want to tweak. I want to add a little bit of extra protection in order to squish my drawdowns. I'll sacrifice a bit of compound annual growth rate, but I want my drawdowns lower. Fine, just slightly increase this, or vice versa. Okay, so you can use it for scaling. You could use it for combining things together. You could even do your so-called master portfolio. So you might be at a position that you've explored our community and you realize that, we're doing, let's say, 3 different trades that are popular right now. And you also want to pair that with, 3 of the popular hedges that we're doing right now. Put that all in one portfolio, see what that looks like, right? Super powerful. And you can see here, by the way, even this thing also can do daily adjustments for you. So you can see here, we could do things, adjust with verticals. We can define certain market biases. We can even define ranges from this delta to that delta for a particular market bias. So again, this is all stuff that's been built for us, by us, okay, for our trades. So yeah, really, really good stuff. And all right, so there's that. And then this, I know this looks like spaghetti all over the place, but basically this is the pink dots here are a representation of the market. This is just SPX. The blue line is an equity curve. So you could easily see this equity curve. This, by the way, is that the SDT with the hedging. The scales are different though. So the fact that you see this blue line being slightly under the pink line, this does not mean that our strategy underperformed the market, because they're on different scales. So it will just fill up the full chart so that both of them pretty much end up on the top right. Okay. But it's still useful to know, because we want to know that if the market is coming down significantly, what happened with our equity curve. And you can see here, it barely came down at all. You just say, okay, that's good. So it's useful to know what kind of market condition you're in at a certain point in time. Okay, so it's those 2 lines, all of these spaghetti curves over here. What this is tracking the P&L of each individual tranche, because remember, we do campaign trading, which means multiple tranches spread through time. And what this thing down here shows you is the number of tranches that you're in at any point in time. So you can see here, we were not in the market at all. There are no tranches there. And then we start to scale in the tranches, and this thing slowly starts to build up. And then we hit the total maximum number of tranches that we've defined in our trade plan. So like over here, we can define what our total max tranches are. And so that's it. At that point, it's going to stop scaling in every single week. So here you can get a visual of how many tranches you're in at any point in time. And what these lines over here do is it shows you the actual P&L per tranche. And that's what the profit and loss is on the left-hand side label. So it gives you a really nice visual, so you get an understanding of the fluctuations of the P&L that you'll see tranche by tranche, and then you get to see the aggregate performance via the blue line. Right? On top of that, you then get to see the risk graph of any particular trade. You can go over here and select any one of the various entries, the actual entry for each particular tranche, and then look at it individually. Or you could go in and at a portfolio level, go through day by day. This increases 1 day, decreases 1 day, increases by 5 days, or goes through to the final part. Or if you want, you could grab this little thing and drag it through to any point. You drop it over here, and then that projects you through to that particular date, and then drag it over here and look at it from this particular date, and you get to see your risk graph for your entire portfolio. All right, then you can see your Greeks over here. This is again at a portfolio level. You can now track your entire portfolio and look at the Greeks throughout time. You can choose the various things that you want to track, and this can even track things like weighted vega as well. It can track skew as well. So really powerful. And this one is probably something you've not seen anywhere else, I'm guessing. What this is a Greek P&L breakdown at a portfolio level. So in other words, and this, by the way, is the STT, the hedged STT. And you could see here that if we look at what the red line is, which is this guy over here, you could see that the vast majority of the money made from this particular trade comes from theta. That may not be a surprise, but you will definitely be surprised for some other trades. So we've looked at some other trades that we've explored in the community, and we've had a situation where the theta line actually looked like this. And you go, what the hell? I thought it looked like a normal income trade. I assumed it would have been making money from theta, but no, money was coming from a different Greek. Okay, and you can see here that we track all the well, multiple of the core Greeks. So for example, this brown line over here is actually tracking skew. Actually, it's a combination of skew and concavity, which you'll learn about in the course. The yellow line here is delta. The green line over here is gamma. So you can see that there are certain Greeks that cause drag on our position, and there are certain other Greeks, in this case, theta and skew, that are the core money makers from a P&L perspective for our particular trade. This is really useful to understand in order to get a good feel for, or a good understanding of the internals of the actual trade that you're actually doing. Sorry, checking messages. Sergey says diagonal trades do not work well in volatility crush environments. Yeah, I mentioned that because I was going to say the positive vega, weighted vega is what matters, not nominal vega. But anyway, but yes, and that's why we slightly lean that core ratio diagonal trade, if that's one that you're referring to lean slightly positive delta in order to hedge the vol crush. Dan says, is a risk graph built into the tool independently? If you mean this graph here, yeah, everything's built into this trade tracker tool, and you get full access to it for free just by being a mastermind member, right? And again, just to give you a comparison, MesoSim, which provides similar style functionality, it is $100 a month. So that gives you an idea of the power of, or the value, that extra value you're getting just by being a mastermind member there. All right. So in terms of the trades that I told you, keeping an ear out for the main trades that the community is currently exploring. Focus on those first when you join our community. And the same thing goes for the types of hedges that we might be using. And you can see here, I just recently ran a poll like a week ago, and I had 80 people respond to that poll. And you can see here in terms of the extra hedging strategies people are using, you can see that the LP factory is this guy here. BSH is like another putback ratio trade, but it's an out of the money putback ratio, not an at the money one like the PBRTA that we looked at before. But it kind of evolved. We used to do this kind of factory in the past quite a bit, and most of it has kind of evolved in through to now doing this simpler version of the factory, but it's the same concept. The yellow here is the LPTA. Remember, this is adding extra hedging based on the 4 of the 5 red flags firing. PBRTA is this one over here, so not as many people doing that. And then you can see that there's a decent amount of people doing the core ratio diagonal. So the main ones are the LP factory, the LPTA, and the core ratio diagonal, right? So you would focus on those as an example to start with, anyway. Then in terms of the so-called income trades, if you want to call it that, because remember that our income trades are always paired with a hedge. So it's kind of like a combo trade, right? And you can see here that we've got this thing over here called the Atlantis. I've not shown you a risk graph for that, but it's basically kind of like a broken wing fly together with a calendar or diagonal combined together. Then we've got this orange one here, which is an M200. This is kind of like a broken wing fly with a vertical or diagonal embedded in there. Then here we've got the STT, which I've shown you, which is like a broken wing fly with extra hedging. And then we've got the 488, which I've also shown you that this is the broken wing fly with hedging in the same expiration instead of splitting those expirations out. So you can kind of think of these as kind of like combined. They're extremely similar. It's just the hedging either being in the same expiration or in a different expiration based on this one. So other than that, they're pretty similar. So you can see this one, and this one is where I would recommend that you start with, right? This is the core trade in the course. And then these are the two most popular trade variants today that work well in today's market, right? So you would start there, even though we've explored over 100 trades. All right, just I also asked people, do you have any feedback on the mastermind? And you guys can read through that, but you could see here everything from, well, actually, if I tell you about the so-called constructive feedback, you could see here this comment down here basically saying, very happy that I found this group, even though I've only been a member for a few months. I've already learned a lot. And yes, the content was overwhelming at first. I'll definitely stay with the group. So you can see, the overwhelm is not a rare thing. That's pretty common. There's another comment over here saying pretty much the same thing. But you could see that, it really is a sign of the value that you get. There's just a ton of value there to explore and learn. Okay. And we're always around. I'm always around. I'm always on. And so are hundreds of thousands, actually, potentially, of people that have done the course that are all willing to help out too. Sorry, just checking comment. All right, so Kirill is saying, based on your presentation, you are making a campaign with weekly tranches. Have you ever tried the same approach for the weekly campaign? I mean, tranche trade every day for a week. How was the model holding August 5th, Japan, blah, blah, blah. Yeah. I'm not sure if you were around when I explained there are specific good reasons for trading further out in time. And that is a lot of what we do. That said, we also have trade variants that trade closer in time too. So everything from 30, 60, 90 days. We've got trades that are in there. We also have people in our community that do 7 DTE. We've got people that do 2 to 3 DTE. We've got people that do 0 DTE with other trade types, not with our core trades. But our core trades tend to be further out in time for the reasons that I've mentioned before. Okay. But again, since we've explored as a community so many different things, you'll have people that have dabbled in all of these, shorter term trade types as well.
Okay.
Okay. Another thing I'll say that's relevant to this is that one of our criteria for putting a decent amount of effort into our trade evolution and looking into new trade variants and so forth is scale. Okay. And I've mentioned that we've got a bunch of people in our community that literally run hedge funds that trade millions of dollars. So we tend to not waste, I don't know, that's probably a bit too strong, but I'll just use that term. We tend to not waste time with trades that don't scale. Okay. So if you're putting on a trade and you say, oh, I'm doing this for so-called beer money, like you hear some people say that, make a couple of extra $100 here or there or whatever. If we find that it doesn't scale, we tend to not put that much effort into it because we want all of our community to be able to take advantage of it, from the small retail trader through to the people that are actually running the hedge funds, ideally. Okay. So if it's something that doesn't scale, we typically put it to one side and leave it perhaps to another day, because we just have so many other interesting things to look at which can scale potentially, and that'll be our core focus. All right. So here, this is useful to look at too. This is not a backtest, even though it looks like a backtest, right? This is one of our members. As a matter of fact, this is the guy that created that trade tracker software that I've just demoed to you. Okay, so very smart guy, been with us since day one, I believe, and very active in our community. And you'll see that he's referring here through to this M200. So if I go back, this was the M200. So you can see it's a popular trade in our community right now. And he shared this. This, for those of you that are with Interactive Brokers, hopefully this should look familiar. This is an Interactive Brokers export of live trade performance of his portfolio. Okay? And that's the blue line here. All these other guys are just other benchmarks. So SPXTR, this is SPX, but basically this is a tracker that also tracks dividends as well, combined. And that's the green line. The yellow line, EFA, is an ETF that tracks Europe, Far East, and Australia. So basically think of developed international markets. and VT is the Vanguard total market. So in other words, developed, emerging, everything. Okay, large cap, small cap, everything together. And you could see that the benchmarks all track pretty similarly. They all took a pretty significant drawdown during this particular period, had kind of like a V bottom, and then, zigzag or whatever. But notice how much nicer the blue line is overall. Not just the fact that it beats everything over here in terms of all of these benchmarks, but also how small the drawdowns were there. If you want specifics, you could see that it basically tracks from about 990 up through to, what is that, 1400-ish? Okay, and then if you work that out as a percentage, you'll see that he is up on his entire account 40.5%. And this is not a backtest. This is live trade performance. Okay, and what is he actually trading in his account? He's trading the M200 together with LP Factory and LPTA. Excuse me. Okay, so just an example of the fact this is stuff that works in the real world, real performance from real traders using all of the stuff that I've been telling you guys about, and is not just based on some kind of curve fit backtest. Okay, and what I should also point out is not only is that an insanely good return, right, 40.5%, but his max drawdown was 3% during this entire period, year to date. Okay, even though the markets took a pretty significant hit here, and he was down 3%. So I would assume most of you would be okay with a 3% drawdown and sleep all at night with that. Okay, especially when he's making like 40% here on his account. By the way, I did want to show this because I want to show you an example of something very recent. He just shared this like a couple of days ago. And to show you something real, not a backtest, but some real performance from our traders. That said, I do not want to put into your head that I'm trying to claim that you'll be able to make 40% returns every year. Okay, 20% returns on your entire account is reasonable with our style of trading with reasonable drawdowns. And what I mean by that is, imagine somewhere in the range of, let's just call it 15%. Okay, 20% return on your entire account with a 15% drawdown. That is quite typical from what we see in our community for our options trading. That said, you can definitely get better results potentially if you're leveraging multiple different things that we teach within the mastermind community. Because remember, this M200 is actually one of the many trades that we've looked at in the mastermind community. It's not part of the core PMTT course, but remember, the mastermind is only made available to people that have completed the PMTT course. Okay, because you need to learn to trade safely in portfolio margin accounts in order to do all these types of things. But yeah, I just want to lay that out, right? I'm not trying to claim that, hey, you'll be able to make 40%. No, set in your head, 20% is a reasonable target, and I think is an awesome target to hit, right? You're killing the hedge funds out there if you could do 20% a year with controlled drawdowns. Okay. Anything beyond that is gravy, as they say in Australia. So now, final kind of thing that we're going to be looking at here is something we call return stacking, or I sometimes call it double dipping. All right, let me quickly explain that. If we just look at the core trade that we do, which is kind of like a broken wing fly, then with like some extra hedging, this thing over here is a put debit spread, this part of the wing, and this part of the wing over here is put credit spread. Okay, the debit that we pay over here is mostly, almost completely offset by the put credit spread credit that we get from the back wing. That gives us this upper expiration line here, which is extremely close to the zero line. So in other words, to simplify all that, the combination of this thing over here does not consume much cash at all. Very little. But if we then need to make adjustments and buy put debit spreads on the way down if the market's coming down and whatever, this is a debit. So we might need a bit of additional cash to make adjustments. Even though we need very little cash to put on the trade. Now, I should qualify that this consumes mainly margin, not cash. Whoops. Okay. So our trades, our portfolio margin trades, tend to consume mostly margin, not cash. But we still need some degree of cash in order to make adjustments. So let's pretend that we start off with 100K in an account. And so then what we're going to do is that we're going to split off a portion of that account just to have off on the side for cash, either for the initial debit that we might need for establishing the trade, or for the adjustments that are required that we might be making on a daily basis. Okay, so let's pretend that we simply do an 80-20 split. So we now have 20,000 in cash for, let's call that a reserve or something like that, right? Off on the side that we're not going to touch, we're going to keep as cash. That implies that we now have $80,000 of cash that we can potentially put to work. All right. So now all of this is, of course, going to be considered for our margin. So we still have a $100,000 account. All I'm saying is that we're going to keep 20,000 in cash, but then we can use $80,000 more effectively than just keeping it in cash as well. All right. Now for this $20,000 in cash, we could even put some degree of extra performance into that, and we can either take advantage if our broker does a cash sweep, like Interactive Brokers does. That's a no-brainer, right? That's going to get you somewhere between 1 to 4.5% return on that cash. So easy, right? Free money, right? Extra money rather than just keeping it in cash. If you are at a broker that doesn't have a cash sweep, such as Schwab and various others, then you can potentially buy treasury ETFs. And the reason that I've got this little asterisk there is because on a daily basis, if you find that, for example, your cash level, because remember you've got 20K there of actual cash there now. Let's forget about this for now. So you pretend that you only had $20,000 of cash, and you've now consumed all of your cash because you've purchased treasury ETFs with that. And now you make a daily adjustment, and now your cash levels are at a negative cash balance. Let's say it's at, I don't know, $2,000 negative cash. If that were the case, then if you did nothing, then you're now going to have to pay margin interest on those $2,000. It's like a $2,000 loan because you're at a negative cash balance. Okay. So all you've got to do is that you basically sell off $2,000 worth of your treasury ETFs in order to bring $2,000 of cash back into your account before the end of the day. If that's the case, if at the end of the day, you're basically back to a zero cash balance, you're not going to be charged any margin interest. Okay. So if you do that, then you can get close to let's call it a 4% return roughly by now leveraging treasury ETFs. So you're now going to get, let's say, 4% on the $20,000 as long as you're doing this daily management. Now, if you're doing cash sweep, you don't even need to do that. It's just automatic. Okay. But that is a way of squeezing out more profits from this chunk of the money that you've got there. Now for the 80K, that can get potentially more interesting because yes, sure, you can also do treasury ETFs, just like what I've talked about before. You don't need to worry about this daily thing anymore because that is what this chunk is for, right? For the $80,000, you can just buy treasury ETFs and hold kind of thing, right? And now get your 4.5% return, whatever that might be, from just those treasury ETFs and be fine with that. That's fine. You could also just do actual treasuries. You could buy T-bills directly from treasurydirect.gov, right? That's another way of doing that as well, because now you don't have any expense ratios or whatever you got to pay for the ETFs. Or even easier and better, you could just do an option trade called a long box, and that can extract even better rates than what you will typically get from these guys over here. Okay. So feel free to explore that. It's a well-known option trade. It's basically two verticals at the same strikes, and you basically can extract the treasury yield from that. So that is a nice and easy way to get an extra 4.5% now on this 80K of funds that you've got in your account. super safe, right? Probably the closest thing that you can get to being almost zero risk. But if you're willing to put a bit of extra work into this, you can now explore using the 80,000 which you originally have in cash to now buy ETFs. And if you do this well, and I know it sounds self-serving here, but I've got a course called Portfolio Investing, which teaches you to do exactly this. And you can now extract a conservative, let's call it even like an extra 10% return, but with shallow drawdowns. Okay. So SPY has multiple times had drawdowns of 50%. Okay. You don't want that. 50%. I typically find drawdowns greater than 20%. That's where people start losing sleep. Okay. So that's kind of like a good number. You want your drawdowns to be less than 20% so you can sleep at night. But you can't do that if you're just buying SPY because SPY has drawn down multiple times by 50%. So you need to do things a little bit smarter than that. You need to learn to put portfolios together that leverage multiple different strategies that take advantage of different factors that give you diversified returns, which are uncorrelated. That's the key. That's the holy grail. And if you can do that well, you can now get, let's say, your 10 to 15%. Let's just stick to 10. Let's just say 10% return yearly, but with shallow drawdowns. Let's say 20% or less. So you can sleep at night. Ideally around 10% drawdowns or 10 to 15%. Okay. So nice and shallow. And now, if you're in that particular situation, you could be getting 20% overall returns just from your option trading and doing PMTT and mastermind style trades, or better, like what I showed you with what you saw there from Werner doing 40% on his account year to date. But let's just stick with 20%. But that is just the option trading stuff that you're doing with your portfolio margin option trading. But then if you're doing these extra steps down here, you're now return stacking on the same account. So you're now getting 1 to 4.5% on this 20K over here. And if you're doing the ETF stuff, you could potentially be getting 10 to 15% returns on the 80K here. Those things combine. Okay. So you might now be looking at overall at let's say a 30% return on your entire account by doing this return stacking or double dipping. The key is to do this conservatively with strategies that have shallow drawdowns, because you don't want to be taking large max drawdowns here, because now that's going to affect your option trading. Now you start getting margin calls from your option trades. You don't want that. Okay. So that's the concept of return stacking. And we've done a bunch of work there too. So this is something we call the Borg Collective, which our entire community has been working on for years now. Currently up to version 35. And you can see the results here going up to current day over the last, 5 years or so. Compound annual growth rate. This is a fully mechanical backtest, okay? No discretion whatsoever. As a matter of fact, this thing can be traded automatically as well, using a technology called Composer. So if you're based in the USA, it can literally be on autopilot. You don't do anything. You just press a button, turn the strategy on, walk away. You're done, right? Backtest over here showing 29% return, compound annual growth rate, max drawdown, 2.32%, right? You might say, hey, you're just showing me something that's curve fit. Okay. You could say that, but when you join our community, you'll see there are people that have been trading, of course, prior versions of this, because version 35 just came out like, I think 2 weeks ago. But we've been trading prior versions of this, which is composed of roughly about 15 algos or strategies combined together in one portfolio. Okay. So even though version 35 might have, let's say, 2 new things that we've added overall, we've been trading 13 or 14 or, whatever, in prior versions live. Okay. So, and we've been trading this for, I think, close to 2 years now. And the performance has been tracking like our backtest has been tracking. All right. But this is the key, to be able to have a bunch of diversified strategies that give you uncorrelated returns such that your max drawdowns are squished down as much as humanly possible, and you get just you get a nice smooth equity curve without those big drawdowns. That's the key when you're doing return stacking. All right, here's a view of what that looks like in terms of monthly returns, if you want to look at that. So you can see, yes, you'll have some months that take small hits, right? But they're like almost nothing. And this is the key. This is the kind of thing I love to see, right? Where the market over here is coming down, 25% over here, and our strategy stays right up here at drawdown about 2%. Okay. Now, again, to me, this is the level at which no sleep occurs, right? But we want to try and squish this down as much as humanly possible via diversification. And all this takes a lot of work. This is what community is for. And what you'll find, I think, is that our community is pretty unmatched in terms of how collaborative we are, right? Most communities out there, it's just the guru presenting one-way information to the students, and the students tend to not share information because of greed and fear. And there's no point to people sharing because, either steal the strategy or they think that the edge is going to go if we share and whatever. We're not like that at all, right? We all work together, collaborate. No one brain knows everything. We leverage everybody in the group, and you'll find that it just becomes like a snowball effect, like you share something, even if it's just an idea, and then from there people, evolve that idea, come up with new versions, new ways to tweak it and whatever, and some other person codes it up, and another person runs a backtest and reshares that into the next mastermind session, and before you know it, we've got something that looks like this. Okay, and then combining that with return stacking, where you're now, instead of this, you're now talking about 25% return for this chunk, and then you're adding 20 or 30 or 40% return for once you learn to do this well, like you saw from here. I think that's the way to go. All right, so we're already at 2 hours. So I had a feeling it would be the case. So here's in terms of next steps. If you do want to go further, I would, I know it sounds self-serving, but I would recommend going down this path because this gives you a $200 discount on the two main courses, which I recommend that you start with, which is portfolio investing and the PMTT course. This is for the advanced option trading course here, but I would recommend that you start here. This is what's going to teach you to do the ETF investing, which is just mainly monthly rebalancing, but our composer strategies, which you'll get access to, by the way, with the portfolio investing course as well as the mastermind. It's shared in both locations. You'll get access to this. Okay. And you can basically put this even on autopilot if you want to. And that now takes care of this this chunk here. Right. And then after you've done the portfolio investing stuff, you can then go through the PMTT course and learn how to extract an additional 20% from your overall accounts. Same account, but now you're using option strategies to get that extra bump, and you're now leveraging the best of both worlds there. Okay, and then if you want to join up, you can use Dan's affiliate link there so that I know that you're coming through his community. And of course, you can look at anything. If you only want to do PMTT, that's fine. I do strongly recommend that you start here and then learn that. So therefore, this is a way to get that $200 discount by using this one over here. So that's all I got. So I'm hoping that that's been useful to you guys and you've gotten some gold nuggets out of there. And even if you don't purchase the courses, there's plenty of stuff there that you can, I think, apply through to your own trading.
Yeah, that was great. Thank you. Is there a way to well, if there's any questions out there too, anyone raise your hands or put them in the chat. Is there kind of a broad overview of what is the ideal trader that this is for, like in terms of account size, experience?
Sure. Yeah. Okay. For this course over here, absolutely nothing. So I literally had my teenage sons go through this in order for them to learn how to put their savings, which at the time was, a few $100s in their kind of bank account to work. Okay. So this is, and even though I say it's like simple knowledge to learn, it's crucial knowledge to learn because you'll be able to apply stuff from this particular course through to all of your trading, not just ETF style trading, right? Learning to analyze risk and how to measure drawdowns in specific ways and using the tools that I make available there that you can use for everything. Really useful stuff. And you can use this to trade your 401ks, your retirement accounts, the money maybe for your parents or whatever. You can teach your children to then invest. All of this stuff is really useful. So that's why I suggest starting here. And again, you can start with account of any size. For this over here, you are learning portfolio margin specific strategies. So ideally, you should be able to qualify for PM accounts, which implies 125K of money that is required for you to have like the minimum balance to open an account. And you then have to maintain this at greater than 100K. If you drop below 100K, you'll get a margin call. Okay. So that is the stock standard reply. Now, that said, if you have a smaller account than this, and you say, I still want to do these trade types, but I don't have 100K, and let's say you've got 50K, you can still take advantage of these strategies. And now, instead of trading SPX options, you're now going to be trading ES futures options. Okay. And this is going to take, this is going to leverage something called span margin. It's not portfolio margin, but they're extremely similar. So, so even if you've got something like 50K account or 20K account, you can still use ES futures options to do the same types of trades as what actually, I shouldn't even say same type, the exact same trades. It's just that you're using a different instrument. You're using ES futures options instead of SPX options. Now, what's the downside? The downside is that you will be spending more on commissions trading ES futures options than you'll be spending on SPX options. So what I would say there is do that until you get your account to a size of 125K. At that point, you switch to now trading SPX options because now you're going to cut your commission costs by about a factor of 4, which is significant.
Yeah.
Right.
And there were some, when I was really active in there, were there some strategies like the clipped wing butterfly
Yep.
that are designed for accounts under 100K, or was I mistaken on that?
Yeah, the clipping butterfly is one of the variants that we have that can be traded in a standard Reg T account. So an account of any size. And you're not taking advantage of portfolio margin there. That's more of an at the money structure.
Yeah. And
Right.
the STT, the basic STT is as well, isn't it?
No, the STT is a
Portfolio?
portfolio margin trade. Yeah.
Okay.
But
Okay.
again, you can trade that in a smaller account using ES futures options. So
Right.
it's still viable.
Right.
And we've got plenty. I'd say we've got maybe, I'd guess somewhere around 30% of our community are probably trading ES futures options because their account sizes are smaller.
Oh, okay.
And that's perfectly fine.
Yeah.
Yeah, but if your account size is larger, then you definitely want to switch to SPX options and do
Yeah.
PM trading.
And when you say the majority of the trades are like 30 to 60 days in length?
Okay, so there's a difference
Duration?
between the contract that you're trading versus the amount of time that you stay in the trade. So those are two different variables, right? So we do trade further out in time, but sometimes you'll be in a trade for in and out within, I don't know, say 60 days, which to a lot of people sounds like that's crazy. Like, that's a long period of time. But remember that you're doing the tranches throughout time. So you're kind of like scaling in and at the same time peeling off profits once you're fully loaded, right?
Right.
And then you'll have other periods of time where, for some reason, your profits will come in really, really quick. So you might be in and out within just a matter of weeks. But and then you've got all the other trade types that are explored within the mastermind community that might be targeted through to smaller DTEs, and therefore you're in and out much more quickly on that as well.
Right. Yeah.
Yeah.
Let's see. I think we have a question here. Did you mention how much time, hours per week, do we need to put into this or put this to work?
Yeah. All right. So on that, there's two aspects to it. One of them is how much time do you need to learn it? And the other thing is how much time you need to actually trade it. So to give you rough numbers, This course over here, from memory, I think is about 15 hours of video content, and you can always double speed it and get through it more quickly. Once you're done with this will take you roughly about 30 minutes per month to manage. Okay. And like I said, if you were to do like the Borg strategies via Composer, and if you live in the USA, and the reason that it's not that it doesn't work if you're not in the USA, but Composer leverages a broker called Alpaca for fully automated trading. And Alpaca currently only accepts USA members or citizens in order to create the broker account. So if you want 100% hands-off trading, fully automated by the bot, then you need to be within the USA. Now, do we have people that are international members that are trading the Borg strategy? Absolutely. So all that happens there is that the Composer system will send you an email 1 hour prior to the close, and it will tell you what the weights should be for every single ETF, and you then simply mirror that manually yourself at your broker, like Schwab or TradeStation or whatever you're actually using. So it's not a problem. It's just that it can't be 100% automated. You have to manually mirror the trades yourself. Okay. So, but for the standard stuff that you see in portfolio investing, again, 30 minutes a month is all you need because typically it's just monthly rotation and that's it. So super easy. And that's another reason why I recommend doing this one first. Then for this one, this is definitely a much more detailed course. This is roughly about 60 hours of content in terms of video content in there. And then you of course need to get some skin in the game in terms of doing the backtesting, learning to use the backtesting tools, ideally also learning to do manual backtesting via a technology called OptionNet Explorer, which I still recommend doing manual backtesting as well. And so, of course, those things take some time to learn to use those tools. But then once you've learnt the material, and then in terms of how much time does this take? Remember, I've mentioned you're checking max once per day, even if it's out of normal trading hours, right? So you're going to check that dashboard. From there, you're going to see if your portfolio is out of whack in terms of the actual deltas, and if they are, then you will need to add those verticals that I've mentioned. And to be honest, on the days that you have to make adjustments, which won't be every day, but you could probably expect maybe 30 minutes a day for you to submit your orders, get the fills, and if you want to be picky with fills and get a good fill, you may have to wait 5 minutes and then tweak it and wait 5 minutes and tweak it, that kind of thing. So let's say 30 minutes a day, I think is very generous in terms of the amount of time that you'll need to spend, no more than that. And you'll also go plenty of days where you don't need to do anything because your portfolio is actually balanced just fine. No need for an adjustment. You just check the charts once a day, which takes 30 seconds, and you're done.
Yeah. When I was trading, I went many days without having to do anything. Just kind of glance at it. Okay, so Mary, you gotta teach me how to play golf. She says, do you need to take the 2 courses and then can join the mastermind monthly?
No. So the portfolio investing and the PMTT course are completely separate. The mastermind exists only to people that have completed the PMTT course, though. Okay, so in other words, if you were to only purchase portfolio investing and you then wanted to join the mastermind, there is no path to that. You can only go from here into the mastermind. Okay, but I do recommend that people consider going through the portfolio investing course if you were to buy this bundle and get both in order to be able to get a $200 discount by getting that bundle. And this is me literally just throwing some kind of bribe because I really believe that there is a lot of utility in people doing both of these things together in order to be able to do this, right? In order to be able to do return stacking. This is really powerful to be able to add these things together. And very simple to do. Once you've, and remember, for this, you'll get access to the Borg Collective, which is doing like 29% returns with 3% drawdowns. There's huge value there, So and so that return stacking is pretty useful, and it's a very easy thing to get into place. And then you can take your time learning the more advanced option trading stuff that you'll find in here. But there's no requirement to have to do both. You can absolutely do, just go down this path or just go down that path, and later on, buy the other course, but then you miss out on the $200 discount by getting the bundle now.
Yeah. So Mary says, is there a time limit for when the courses need to be completed after you register?
No, the way that I've structured things, you get lifetime access to the courses. So you can take as long as you want. You can go through it 2 and 3 times, whatever you like.
And she may be referring to like if she joined the main course, could she join the mastermind immediately?
Okay. Can you? Yes. I don't have technology in place that will, put a stop sign in front of you and say, don't do it. But I will tell you, I don't recommend it. And the reason for that is because you've got enough learning material in the PMTT course, and it's important material to understand and learn before you join the mastermind. It's kind of like going through a university. Think of that as the PMTT thing, and think of the mastermind as like the PhD level. You don't want to step into a PhD class and then be asking questions where everyone's looking at you going, "What the hell? Like this is basic stuff," you know? So put in the time to learn, go through that university course, right? Learn the stuff that we consider to be baseline level knowledge that you need, and then when you step into the mastermind, now you will be uh, among peers of that kind of level, and you can now talk at that advanced level instead of having to kind of ask
Yeah.
stuff and you go, oh, geez, I feel kind of weird asking these questions. So maybe that they're too basic, which they will be if you haven't gone through the course. So,
Yeah.
and this is another reason why I've put in the lesson for the mastermind course literally at the end of the PMTT course. I don't want people joining the mastermind until they've completed the PMTT, but I'm not going to stop you um, if people do that. I just don't
Yeah.
recommend it.
Right. Do you have any stats on that? Like I did. I'm guilty as charged, and I'm sure
Yeah.
everyone else is.
Yeah. No, look, and I know there are people that do that. I will literally see, I'll see the sale for the course, and then 30 minutes later they join the mastermind. I'm like, oh, dude. Um, but what tends to happen is I'll typically get people that have maybe been trading for some time. Like I've got people that are ex-market makers. I've got people that literally have run hedge funds prior to going through my course, and they just assume that they already know everything that's in the course already. And then they'll quickly join the mastermind to see, what are people doing in the mastermind, just out of curiosity. But then they go through the course and they go, oh, you know what? I actually did learn a lot of stuff from the course, even if they're advanced traders already. Um, and which is a surprise to some people that consider themselves to be advanced traders, you know?
Right.
So yeah, and I think there's enough overwhelm already for the average trader just going through the main PMTT stuff, let alone 250 sessions of 3 hours of stuff and just getting a mountain of trade variants and tools and whatever. The overwhelm is just a bit too much if you just go straight into the mastermind, even though I understand people's motivation. They just want the new shiny toy and they just want it now. So um,
Yeah.
I'm not going to stop people, but I just don't
Yeah.
recommend it. Yeah.
Yeah. So, and so something I wanted to mention. So I just want to make sure it's the right fit for everybody. Take your time and think about it. And but some of the things that I've made a spreadsheet of like Boomer Dan's favorite mastermind sessions. Like I have a Excel
Mhm.
sheet where like the greatest hits
Yep.
and going through the course. And you just recently revamped the whole course, didn't you?
Yep.
Like or a bulk of it. Like the first course came out in 2016, and then you just revamped it this year, I think.
Yeah, I revamped it a while back because I found that we had evolved things quite nicely in the mastermind group through the years. And then I just found that it was about time to incorporate some of those evolutions back into the core course in order to give people access to these updated ways of doing things more efficiently. And that doesn't necessarily mean that, you know, the old way of doing things no longer works, but we found ways, for example, of doing things where your commission costs would be cut by a factor of 4. So why not, right? A simpler structure that is, one leg instead of three. Why not? It will fill more easily. You'll be able to get out more easily during a crash event, and pay 4 times less commissions. There's no downside. So things like that evolved. I've still kept the original version of the course of the people that still wanted to see it.
Right.
But I restructured it so that if you go from top to bottom, you're getting the revamped version of the course first, and then you'll see the archive stuff underneath that if you did want to see what the original version looked like.
Yeah. And that course is so in depth. I mean, there's stuff in there that I don't think you could learn anywhere else, really, like in one place. Like skew was an example. I had no idea what skew was
Yeah.
until I went to your course, and then like
Yeah.
you know, I would have gotten hit by it, and then had no idea what happened, and maybe just threw the whole towel in on everything.
Yes.
So
Yeah.
it's
And that's the
super.
whole multi-layered thing about options, like once you start learning those layers, you then go, oh, geez, I didn't realize there's actually three more that I didn't know about before.
Right.
And yeah, they all affect P&L. And yeah, so yeah, it's a cumulative thing, and but then as you get more and more into these things, the nice thing then is that when you look at a new trade variant, you now know exactly what to go for. You go, oh, I got a feeling this, the skew is going to be bad on this, and it's going to be affected like this with the T plus X lines. But now you'll also know and have access to tools that can now validate your assumptions and quickly put it into the backtest, run a 10-year backtest in minutes, and then do the P&L Greek analysis like I showed you guys and all this kind of stuff. And you've now got actual data that can validate the things that you thought might be an issue. You can now look at it and say, yeah, that absolutely is an issue. This trade does not make money from theta; it makes money from skew, as an example, like what I
Right.
talked about before.
Yeah. And the mastermind, like I said, I've been calling it the creme de la creme. That thing is there's like so many little hidden gems in there, like
Mm,
super cool little uh like black swan hedges that just someone will come up with in the community and share it and do these extensive back test sessions on the mastermind, or like all of Dave Andreessen's, that's his
mm.
last name, right? Andreessen's, like
Yeah.
his in-depth back tests with those videos of like it actually going through like a whole period of time, like for 2 hours.
Hmm.
All that stuff is just so, I'm jealous of your mastermind. That's my goal to hit that level.
Yep.
It's really, and the search function too you've created is super simple. Like if I have trouble finding one through all those months back, I can just put in like Black Swan Hedge and it'll pull them all up, the
Yep.
clump of them.
Yep. Yeah, and it's also like tangential things too, right? Everything from, tax stuff that we've talked about, retirement structures, um, corporate entities that you can use, or then people wanting to form hedge funds, automation tools. I've dealt with that a lot. And these days, I've been spending a lot of time with teaching people how to use AI for trading related stuff, um, coding or yeah, a whole bunch of stuff. Everything that I can think of in order to help traders, I put into these masterminds. The second that I finish a mastermind session, the next day I literally start planning for the next one and doing the research and all that's required for that kind of content. So I'm constantly on the hunt of uh, ways to help the community make money from trading and expand themselves as traders.
Yeah. And there's two of those a month, right? Every other week.
Yeah, every 2 weeks. Yeah.
Yeah. All right. Well, if there's anybody else have a question, and anyone who wants to, like, I've been in there for years, and I'll give you the honest skinny on it. If you want to just if you have questions you want to ask me, just email me, or we can get on a phone call. And if I don't know the answer, I can reach out to Ron. We'll get it for you.
Yep.
All right. Well, that was a massive production, very well done and really informative. Thanks so much for coming on and doing it, Ron. Really
No worries.
appreciate it.
All right. Hopefully it helped.
Yep.
All right.
Okay, guys. Thanks. We'll see you on the next one.
All right. See you later.